You're scrolling through Zillow again for the third time this week. Every house you click on has the same problem. The price starts with a 5. $500,000, $525,000, $550,000. And you're sitting there thinking, maybe I'm missing something. Maybe I'm just bad with money. Maybe everyone else figured out something I haven't. But here's the truth nobody wants to tell you. You're not missing anything. The math is just broken. A $500,000 house is not affordable for most people, not even close. And the fact that banks keep approving people for these mortgages, that doesn't mean you can actually afford it. It just means the bank is willing to let you destroy your financial future. Today, I'm going to break down the real math behind a $500,000 house. Not what the bank says you can borrow, not what your real estate agent says is normal, the actual numbers. And then, I'm going to show you what you should do instead. Because if you make the wrong decision here, it could cost you decades of financial stress, broken dreams, and money you'll never get back. Let's get into it. The new normal that makes no sense. Let's start with where we are right now. In most major cities across the US, Canada, and the UK, $500,000 doesn't buy you a mansion. It doesn't even buy you luxury. It buys you a standard 3-bedroom, 2-bathroom house. Maybe 1,500 square feet. Nothing fancy, just normal. Seattle, Toronto, Austin, Denver, Portland, Miami, even smaller cities within an hour of a major metro area. They all share the same reality. $500,000 is the starting point. Now, let's talk about income. The median household income in the United States is around $80,000 to $85,000 a year. In Canada, it's about 90,000 Canadian dollars. In the UK, it's roughly 35,000 pounds. So we're asking the average household, people earning $80,000 to $90,000 a year, to buy a house that costs 6 times their annual income. Let me put that in perspective. In the 1970s, the average home cost about 2.5 times the median household income. You could buy a house for $50,000 when people were earning $20,000 a year. The math worked. Today, we're at 6 times, 7 times, in some cities, 8 times. That's not a small shift. That's a complete restructuring of what homeownership means. And yet, somehow, we're all pretending this is normal. Your parents bought a house at 25. Your friends are posting their new home photos on Instagram. The bank says you're approved, so it must be fine, right? Wrong. Let's run the actual numbers. The down payment trap. Let's start with the down payment. The traditional recommendation is 20% down. On a $500,000 house, that's $100,000 in cash. $100,000 sitting in your bank account, ready to hand over. Now, according to recent data, the median savings account balance in America is around $8,000. That means the average person is $92,000 short. Not a little short, $92,000 short. But I'll just save for it, you're thinking. Okay, let's say you're earning $85,000 a year. And let's say you're incredibly disciplined and you save 10% of your income every year. That's $8,500 a year going into your down payment fund. At that rate, it'll take you almost 12 years to save $100,000. 12 years. And that's assuming housing prices stay exactly where they are today, which, if you know anything about real estate, has literally never happened. Prices go up every single year. So while you're saving, the target keeps moving further away. So most people don't put down 20%. They put down 5% or 10% because that's what's actually achievable. Congratulations, you just unlocked a new expense called PMI, Private Mortgage Insurance. PMI costs you anywhere from $200 to $400 a month. And here's the part that'll really annoy you. It doesn't protect you. It protects the bank. You're paying extra every single month because you weren't rich enough to put down 20%. It's literally a penalty for not already being wealthy. The real monthly cost nobody talks about. All right, let's say you've scraped together a 10% down payment. That's $50,000. You now have a $450,000 mortgage. With interest rates sitting between 6% and 7% right now, your monthly mortgage payment is going to be around $2,700 to $2,900. But that's just principal and interest. That number doesn't include anything else you actually need to live in this house. Let's break it down. Property taxes. Depending on where you live, that's probably $400 to $600 a month. Let's say $500. Homeowners insurance. Thanks to climate change and rising risks, insurance has skyrocketed. That's another $250 to $350 a month. Let's say $300. Maintenance. This is the one everyone forgets until something breaks. The rule of thumb is 1% of your home's value per year for repairs and maintenance. On a $500,000 house, that's $5,000 a year, or about $420 a month. And don't forget that PMI we just talked about. Add another $300. Let's add it all up. Mortgage, $2,850. Property taxes, $500. Insurance, $300. Maintenance, $420. PMI, $300. Total, $4,370 per month. That's your real housing cost. Every single month, without fail. And this assumes nothing major goes wrong. No new roof, no foundation issues, no surprise HOA fees. Now, here's where it gets really uncomfortable. Financial advisors typically recommend spending no more than 28% of your gross income on housing. That's the safe zone. Banks will approve you if your total debt-to-income ratio is under 43%. But just because they'll approve you doesn't mean you should do it. Let's reverse engineer this. If you're spending $4,370 a month on housing, and that's supposed to be 28% of your income, you need to be earning about $187,000 a year. Let me say that again. To comfortably afford a $500,000 house by traditional financial standards, you need to earn close to $200,000 a year. And here's the brutal stat. Only about 10% to 15% of U.S. households earn $150,000 or more. Only 10% to 15%. That means 85% to 90% of people cannot afford a $500,000 house. Not comfortably, not sustainably, not without putting themselves in serious financial danger. What being house poor actually looks like. Let me show you what this looks like in real life. Let's say you're a household earning $140,000 a year. That's well above the median. You're doing better than most people. You should be comfortable, right? After taxes, Social Security, health insurance, and a small retirement contribution, You're taking home about $8,500 a month. Subtract that $4,370 housing payment. You're left with $4,130 for everything else. Now let's keep going. 2 car payments, $700. Car insurance, $250. Gas, $300. Student loans, $500. Groceries, $800. Utilities, electric, water, gas, internet, phones, $450. You're down to $1,130. We haven't even touched clothing, medical expenses, kids' activities, date nights, vacations, or any kind of fun. And forget about saving for emergencies or retirement beyond that tiny contribution. This is what being house poor feels like. It's checking your bank account before buying groceries. It's telling your kids they can't do that sport because you need the $50 a month in case the car breaks down. It's lying awake at night, wondering if you can afford new tires or if you should just drive carefully and hope for the best. It's living one unexpected expense away from disaster. The furnace dies? That's $5,000 you don't have. Someone rear-ends you? That's your $1,000 deductible on a credit card. Your kid needs braces? You're financing dental work like it's a car loan. This is the reality for people earning $140,000 trying to afford a $500,000 house. Now imagine what it looks like at $100,000, or $85,000, or the actual median income. It's impossible. The math doesn't exist. Why everyone keeps lying to you. Here's the thing that makes all of this even worse. Nobody in the home buying process has any incentive to tell you the truth. The seller listed the house at $500,000 because that's what comparable homes sold for. They don't care if you can afford it. The bank approves you at 43% debt to income because the loan probably won't default immediately. They're protected. You're not. The real estate agent encourages you to stretch your budget because their commission is based on the sale price. The higher the price, the more they make. Nobody profits from you being financially stable. They profit from the transaction happening right now. And once you're in, once you've signed the papers and moved your stuff in, you're stuck. You can't just walk away 6 months later when you realize this was a mistake. You'd destroy your credit and lose your down payment. So people stay. They stay in homes they can't afford, working jobs they hate, because any disruption in income would be catastrophic. This isn't about personal failure. This isn't about not being disciplined enough or not budgeting well enough. This is a housing market that is completely disconnected from income reality. Home prices have increased about 400% since 1990. Household income has gone up about 180% in the same time. The math cannot work, and we need to stop pretending it does. What you should do instead. So here's the part where I actually help you. If you're looking at a $500,000 house right now and your household income is below $140,000, stop. Just stop. I don't care what the bank approved you for. I don't care what your agent says is normal. The numbers don't work. Here's what you should do instead. Option 1. Buy way less house. Instead of a $500,000 house, look at $300,000 to $350,000. Yes, it might be smaller. Yes, it might not be in your dream neighborhood. But you know what it will be? Affordable. Your monthly payment drops to around $2,500 to $2,800 all in. That's manageable. That leaves room to breathe, room to save, room to actually enjoy your life. Option 2. Keep renting and invest the difference. I know, everyone says renting is throwing money away. But you know what's actually throwing money away? Spending $4,370 a month on a house you can't afford and having nothing left to invest. If you rent for $2,000 a month instead of buying that $500,000 house, you're saving $2,370 a month. Invest that $2,370 every month in index funds at an average 8% return, and in 20 years, you'll have over $1.3 million. Let me say that again. $1.3 million in liquid assets that you can actually access. Compare that to the homeowner who spent 20 years stressed, broke, and house poor, with equity they can't touch unless they sell. Option 3, move to a lower-cost area. If you're hell-bent on owning, consider moving somewhere cheaper. Remote work has made this more possible than ever. A $500,000 house in Seattle might be a $250,000 house in Boise or Des Moines or Raleigh. Same house, half the price. And your quality of life might actually be better because you're not drowning in debt. The point is, you have options. You don't have to play the game the way the system wants you to. The real path to wealth. Here's what actually builds wealth. It's not owning a house you can barely afford. It's having margin in your budget. It's being able to invest consistently. It's not having to choose between fixing your roof and contributing to retirement. Real wealth is freedom, not equity you can't access because you're trapped by the very asset that's supposed to be making you rich. The financial industry has done an incredible job convincing everyone that homeownership is always the right move, that buying is always better than renting, that you should stretch as far as possible because homes always go up. But they're selling you a product. They make money when you buy. They don't make money when you make smart decisions. So stop listening to them. Start listening to the math. Run your real numbers. Factor in all the costs. Be honest about your income. And if the math doesn't work, walk away. There's no shame in saying, "This doesn't make sense for me." That's not failing. That's wisdom. So here's my challenge to you. Stop looking at what you qualify for. Start looking at what you can actually afford without turning your life into a financial tightrope act. Find the number where you can pay the mortgage, handle emergencies, invest for the future, and still sleep at night. For most people, that number is nowhere near $500,000. And that's okay. The housing market will keep pretending these prices make sense. Banks will keep approving loans that shouldn't exist, but you don't have to participate. Sometimes the smartest move is recognizing when the game is rigged and choosing not to play. If this video helped you see the truth about home affordability, subscribe to Wealth Context. We're here to give you the real, unfiltered financial truth that nobody else is willing to say. Drop a comment and tell me, what's the housing market like where you live? Are you feeling priced out? I want to hear your story. And share this video with someone who's thinking about buying right now. It might just save them from the biggest financial mistake of their life. This is Wealth Context. Stay wealthy, stay smart, and I'll see you in the next one.